Okay. Hi, everybody. Yeah, we're recording. Thanks, everybody, for coming. This week, we have Ina Simonovska talking about trade credit. Ina, we go for an hour. People can break in, just unmute and ask questions as we go. So it runs a bit like a regular seminar in that sense. When the hour's up, we leave the stream open for more comments and discussion. So we also have Felipe in the audience today, and he said he'd be willing to also answer questions in the chat. So if you feel like asking your question in the chat, feel free to do that as well. Okay, Ina, go ahead. You've got an hour.
Okay, great. Thank you so much for inviting me. It's really fun to be here. This is joint work with Felipe, who is here, and Brian Hardy, who's not here. He's the Bank of International Settlements, and the views expressed here are those of the authors and not those of the Bank of International Settlements. So the paper is titled Economic Stabilizers in Emerging Markets, the Case for Trade Credit. So I will be trying to convince you that trade credit is an economic stabilizer today. So to motivate the talk, let me just give you two facts about trade credit. So first, let's define trade credit. So trade credit means firm-to-firm borrowing and lending. In particular, non-financial firm-to-firm borrowing and lending. So I want you to have in mind accounts payable and accounts receivable. And I'm focusing here on emerging markets. And in particular, in this picture, I'm showing you a plot for Mexico, where on the left-hand side, I'm showing you what happens for small firms, and on the right-hand side for medium firms. And the idea that I want you to get out of this plot is simply that there is a negative correlation between bank credit and trade credit for small and medium-sized enterprises. So this is quarterly data going from 98 until 2008, and each dot is a quarterly observation. So the idea here is that there is a trade-off between the two types of financing. And then the second fact that I want you to be aware of is that more large firms extend trade credit when fewer small or medium-sized firms get bank credit. So here I'm showing you those same firms, small and medium firms, but on the y-axis here, I have the large firm trade credit lending versus the small firms bank credit. So the idea that I want you to get out of this plot is that basically large firms seem to be providers of trade credit to smaller and medium-sized enterprises. So with that in mind, today we will argue that trade credit is a substitute for debt and that it acts as a macroeconomic stabilizer, in particular in emerging markets. To do so, I will proceed in three ways. First, there will be a theoretical component. So here we will be modeling trade credit to be state contingent along a supply chain. There will be several key predictions that will come out of our framework. So in our framework, we'll have financially constrained intermediate and final goods producers who will bargain over production, the amount of bank debt raised, and the terms of trade credit. And the key feature will be that trade credit supply will depend on the firm's ability to borrow from a bank. The key implications of the model will be the following. The more asymmetric are the costs of borrowing, the more trade credit will be extended along the supply chain. The more debt constrained are the firms, they will obtain more trade credit from less debt constrained ones in order to be able to achieve a higher or more efficient scale of production. And finally, I will show you that suppliers will extend more trade credit to final good producers in a bad state of the world in order to prevent default. So in that sense, trade credit will provide firms with insurance. After showing you the theoretical component, we'll move on to the empirical component where we'll be testing these predictions of the model using firm level data from the Orbis dataset for 8 emerging markets. Our main findings will be that larger and more financially constrained firms will obtain more trade credit and more state contingent trade credit, where the latter is an implication for insurance. And finally, in order to convince you that trade credit in general equilibrium acts as a stabilizer, we will do a counterfactual exercise. we will compare an economy with trade credit, which is our baseline model, to one without trade credit. And I'll show you that the economy with trade credit has less volatile GDP and price levels than the counterfactual economy without trade credit. And also, more interestingly, the economy with trade credit will have a rising share of trade credit in the total set of liabilities, or in total set of flows of funds during crises. So it is this rising share of trade credit that stabilizes the economy. So unless there's any questions, I want to quickly tell you how this paper relates to the existing literature. So first of all, why am I focusing on emerging markets? So while trade credit is present in every economy, in emerging markets, it is a particularly important source of alternative finance. Just to give you some basic statistics from the World Bank Enterprise Survey from 2000 to 2010, and these come from the handbook chapter on finance. In a country such as Korea, which has very developed financial markets, only 1% of the alternative finance source is trade credit. But in a country like Peru, it's almost as much as 60%. And Peru is not at all atypical. In fact, Peru is the typical country that we're observing in an emerging market data set. So that is to say, trade credit is just a very, very important object to study. And therefore, the corporate finance literature has spent quite a bit of time thinking about it. That's a large literature, and I'm not going to summarize all of it for you, but I just want to emphasize two papers that relate really closely to what we are doing in this paper. The first one is a paper by Cugnat in the Review of Financial Studies. And what he finds is that trade credit provides insurance. So in particular, he has a corporate finance model, a model of the firm, where he shows that suppliers end up being liquidity providers because they better enforce debt repayment than banks do due to the threat to end a long-term relationship. This is not a general equilibrium model. It does not study macro properties, but it does emphasize this micro foundation of insurance. And then there's a paper by Shao, which is a working paper from 2020. It's a macro paper where the author shows that trade credit propagates shocks through the economy. So what she finds is the following: in a model of trade credit, where funds flow from financially unconstrained toward constrained firms, when there is a financial shock, the suppliers end up reducing trade credit, and therefore trade credit propagates the negative shock through the economy. In contrast to that, in our paper, we will find the opposite. We argue that trade credit acts as a macroeconomic stabilizer, and that's going to come precisely out of the insurance properties that trade credit brings along. So let me move on to the theory then. So the environment will be the following. We'll have a small open economy where there's two types of markets. There's the centralized market or wholesale market, and a decentralized market or a bilateral market. These are markets for goods, intermediate goods to be specific. There's four types of agents in the economy. There's intermediate good producers. I will refer to them as sellers or S, and that's because they are selling their intermediate goods to final goods producers or to wholesalers, depending on the situation. So the final good producers are buyers, the intermediate good producers are sellers of the good. And then there is a bank, as well as a wholesaler that handles the centralized market for the intermediate good. There's two states of nature, high and low, final good price that are denoted by Z upper bar and Z lower bar, and it's just a two-period model. So let me start by giving you a description of the environment or the problem that an agent is solving if the agent is unmatched. So an unmatched agent means that this agent will only be interacting in centralized markets. I will describe first the first period and then the second period. So in the first period, agents, whether they're buyers or sellers, have to raise debt. They will go to the bank to do so. So the bank will lend them an amount DS to the seller, DB to the buyer. The seller will use that amount in order to pay workers so as to be able to produce the intermediate good. The buyer, on the other hand, will use the raised debt in order to buy the intermediate good from the wholesaler at price PX. So notice that agents here, we will assume, are born with zero wealth, so they have to borrow money in order to be able to pay these costs. So then in period 2, production will occur. How will that happen? So first, the uncertainty will be realized. So the Tayshock will be realized. We'll see whether we're in a high state or a low state. And now the seller will produce his good and deliver it to the wholesaler. The wholesaler will pay the seller for that good, call that amount excess. And then the seller will use that money in order to repay the bank. So the debt payment is DS times 1 plus R star, where R star is the interest rate in the small open economy. On the other hand, the buyer will buy the good from the wholesaler, right? Remember, he already prepaid the good in the previous period. So the wholesaler now delivers the good to him. He transforms the intermediate good into a final good and sells it to the consumer, gets money from that. That payment is Z times XB, and then uses that money in order to repay the bank, the debt at interest rate R star, okay? So let's look at that mathematically. So here I'm showing you the problem that the seller is solving in this case where they're interacting with a wholesaler. So remember, a centralized market. So what is the seller doing? So the seller is raising debt DS and has to pay a cost, psi s, which has to pay a quadratic cost of debt where psi s is capturing the intensity of that cost. So the higher is psi s, the more debt constrained this agent is. Crucially, notice that debt is not state contingent in this model, okay? So raising debt, paying that cost today to raise the debt and paying off the workers in order to produce, that's W times L, all of that occurs today. And then tomorrow, with a discount rate beta, I'm discounting the proceeds, which are the proceeds from selling the good to the wholesaler at price PX, net of debt repayment at interest rate R star. So what are the constraints for the seller? The seller essentially has to start off with non-negative, with a non-negative position. So that means there's no savings, there's no net worth that he's born with. So that's the first constraint. And the second constraint just says that they have to repay their debt. So there's no default, okay? Solving this problem and taking the maximized value, which clearly is a function of how debt constrained this seller is, which is the parameter of psi s, we will denote that by gamma s of psi s, and that maximized value is going to be the outside option that this seller will be bringing with him when he's in a bilateral meeting with a buyer. But before we go there, let's, yeah.
Just a quick question, like this quadratic debt cost, I'm not sure I'm kind of seeing why it shows up in 2 places. Do you have some kind of story for why it shows up in, you know, like I could have imagined like there was some sort of another problem in the background where the firm can somehow run away with stuff and it would have affected like the firm's productivity. I mean, do you have some story for this quadratic cost or something like that? I'm just trying to understand a little bit better.
So let me just ask you first, what do you mean in 2 places? You said it shows up in 2 places.
On like how much I'm borrowing, that is
So
just constraint on D, but here you actually have like, there's some resources that get kind of chewed up.
Right, so the first constraint here just says that you're born with 0 money, right?
No, but part of my debt goes to paying workers and part of my debt goes to paying like this quadratic cost, right?
Right, yes.
I just want to understand what this quadratic cost is standing in for, because it's going to be kind of crucial, I'm guessing.
It is going to be crucial. It's basically instead of, so you can think of a very simple financial constraint here, and that's what psi s is. There are other ways to do that. Like if you want to microfound it, you can have debt that is state contingent, right? That there's default. So default rates can be mapping into these PSISs, but basically the more risky you are for repaying your debt, the higher is that PSIS. You can think of it that way. It's just it's like the simplest possible way of modeling a financial constraint.
Okay. Thanks.
Okay. So now let's think about the buyer. So very similar situation. The buyer raises debt and has to incur this quadratic cost of borrowing, which is just a financial constraint. They have to purchase the intermediate good from the wholesaler at price PX. And then tomorrow, the uncertainty, remember, is resolved, the state is realized, so they get paid Z times XB, which is the amount that they sell to the seller, to the consumer. So clearly here, we're just assuming a very simple a linear production function. You go from input to output in a linear fashion, and then you're just repaying your debt. So once again, this agent has to be born with non-negative wealth. And notice here, the agent's constraint can be binding in the bad state or the low state, because that's the state in which demand is lower. So once I write that binding constraint for the low state, the high state is naturally assumed. Okay, so this is the simple part of the problem. Once we solve the buyer's problem, that maximized value we denoted by gamma B, and that's the outside option in the bilateral meeting that's about to happen. And it's very easy to show here that the more debt constraint an agent is, the lower is their outside option. So now let's think about the bilateral meeting. So there's a matching function out there. So nature matches buyers and sellers. There's a unit measure of each of them. And the matching function is very simple, the simplest one you can get, which is alpha B times S divided by B plus S. And alpha, which is a parameter between 0 and 2, is just captures the matching efficiency. So now suppose that a buyer and a seller are matched. What does their problem look like now? Once again, in period 1, the buyer and the seller need to raise debt from the bank in order to be able to engage in activities. The seller can use the debt in order to pay workers so as to be able to produce. However, that's not the only source of financing that the seller receives. The seller may obtain an amount AB from the buyer in this first period. So in that sense, if you think in terms of accounting, AB is the amount of accounts payable for the seller because it is a payment prior to the delivery of the good that the seller receives. So this is an instance in which the buyer is extending trade credit to the seller. Okay. Now let's go to period 2. These guys are still matched, uncertainty is resolved, the shock Z is realized. Now what happens? Rather than going through the wholesaler, the seller will simply deliver the intermediate good to the buyer, who will transform it into a final good and sell it to the consumer. The consumer will pay an amount ZXB to the buyer, okay? And now the buyer can repay debt, but also pay a certain amount T of Z to the seller, which the seller can also use in order to repay their debt. So notice here, I'm explicitly saying that T is a function of Z. That is to say, the amount that the buyer will give to the seller in period 2 is contingent on the shock, on the state. So in this sense, the combination of AB and T of Z is the terms of trade credit in the model. So in this case here, T of Z are accounts receivable for the seller. That is to say, it's a payment after the delivery of the goods. So naturally, the seller here is the one extending the trade credit. So you now see how A, B, and T of Z map into trade credit extended by a buyer and by a seller. So let's take a look at the problem. So we're going to assume for simplicity that the seller makes take it or leave it offers to the buyer. And let's look at the what that problem looks like. So the seller will want to maximize their surplus from the match over their outside option gamma S. And that's going to be subject to not making sure that the surplus of the buyer is not below their outside option, and a few more constraints. But let's go over the first part here. So now what is the seller doing? So he's raising debt, he's receiving that amount AB, remember in period 1 for the buyer, paying off the workers. Now we will assume that the seller has to pay a cost C only if he ends up providing state contingent trade credit. So this is this C is multiplied by an indicator function that takes on the value of 1 that when trade credit is state contingent. And then we have the same financial constraint, right? The cost of borrowing for the seller, SIAS. And then what is the continuation value here? So the continuation value next period, the seller potentially has some savings, which I have not discussed yet. And out of those savings, the seller has to repay debt, but also potentially gets that payment T, which is state contingent. So T tilde here denotes the average T, that is to say the probability of a realization of a low state times the T payment in the low state plus plus 1 minus the probability of that realization times T in the high state. So that's the notation that we're seeing here. And that's subject to the surplus of the buyer not being below the outside option. So what does the surplus of the buyer look like? So the buyer is raising debt, is making that payment AB in the first period to the seller and paying the quadratic cost. And then he has his continuation value, which basically says that out of his savings, he has to repay debt, make that payment T, trade credit in the second period, and get a payment from the consumer, where here, I'm sorry, I forgot to define this, but Z tilde, just like T tilde, is just the average Z. So P times Z low plus 1 minus P times Z high. George, do you have a question? Because you're unmuted.
So I'm still I'm kind of stuck in this quadratic debt cost, and what changes when basically I guess it's the buyers doing we'll call it lending to the seller. Because on the one hand, like, if both guys have these quadratic debt costs, then I really want to I want both guys to do a little bit of borrowing. But if so I guess that's what I'm kind of confused about. Both guys you want to kind of have both guys do a little bit of borrowing, but it seems like when you have one guy doing borrowing and then kind of giving the money to the other guy, that seems like a more costly way of kind of satisfying like these pre-purchase conditions. So what am I missing that like you would ever want to kind of do it this way?
So do it which way? So without the cost?
So in some sense,
then we're definitely going to have bang solutions, right? We're not going to have everybody borrowing a little bit, and in the data, everybody has some debt.
No, I just
then
like
also trade credit.
Yeah. So what I was trying to understand, suppose if you have, maybe I missed this, if the buyers and the sellers have to kind of pre-purchase stuff, and they have to take some debt on, right? And then the more debt they take on, the worse it is. You really want them to somehow like both guys. You never want a situation where one guy takes on more debt to kind of just give it to the other guy, unless there's some asymmetry someplace that I'm not seeing. Do you know what I mean?
Well, the asymmetry is in the P's.
So that's what it is. These guys have different kind of.
Yes. So there's heterogeneity here. So there's a unit measure of agents of sellers and a unit measure of buyers, but each one within that unit measure, you basically have a bunch of guys with different P's.
Okay, so I missed that.
Yeah, sorry. So that we should have, we should include that on the slide, that the P's is drawn from a distribution. Yes, so everybody's heterogeneous. Thank you, sorry.
Sorry, so I missed it. You probably said it.
No, I didn't. Okay, thanks. All right, so we're maximizing seller surplus subject to a buyer surplus. And now let me just make this problem a little bit easier. So I will assume that beta is equal to 1 over 1 plus R, so that there's no reason for savings here. So that means that the savings for the buyer and the seller, which are defined below, must be exactly zero in equilibrium. So I will substitute them out and I will rewrite the problem with just the continuation value for each agent. So here, the problem simplifies to maximizing the continuation value for the buyer over the continuation value for the continuation value of the seller, subject to the continuation value of the buyer being higher than the outside option. And then I have simply a feasibility constraint that says that the sum of the two debts must cover all the costs that are incurred in the economy. And those costs are the quadratic production cost, the labor cost, and the cost of providing insurance. So far, this is a basic problem, except that there are constraints regarding debt repayment. So what are the three constraints? So the first one is that the seller has to repay debt in the bad state of the world. Of course, the good state of the world here is subsumed because the seller receives the amount T. So to the extent that T upper bar is bigger than T lower bar, I don't need to write that constraint. And then I have two more constraints for the buyer, which say that the buyer has to repay debt in the low state of the world, so that's 4, and in the high state of the world, which is 5. Okay, so that's the problem. I'm not going to solve the problem for you because on the one hand, it's actually easy to, a lot of it is pen and paper, but there's just a lot of cases. So I'll just give you a sense of what it looks like, okay? So if you take first order conditions of this problem, the thing that really pops out is simply that the buyer and the seller will finance production according to their debt capacity. So that is to say, they will borrow according to how constrained they are relative to their partner. So that's the ratio here of D's being equal to the ratios of C's. And then there's 4 cases that emerge in equilibrium. So there's 2 scenarios without insurance and 2 scenarios with insurance. Starting off without insurance, there's the best case scenario where nobody's constrained. That is to say, 3, 4, and 5 are not binding. And in that case, debt, trade credit, and production reach optimal scale. But because of this object C here, which shows up in constraint 2, you don't want to pay that cost. Insurance is costly, so trade credit ends up not being state contingent. Then constraints start to bind. So we start off with the buyer's constraint binding in the bad state of the world, but the seller is still unconstrained. In that case, because the seller is unconstrained and insurance is costly, the seller still does not end up providing state contingent trade credit, but production scale and debt are constrained below the unconstrained optimum in case 1. But now let's go to the more interesting cases. So the more interesting cases involve insurance. Certainly insurance is costly, but it relaxes the binding constraints of the agents and therefore raises output. So once that C is paid, it is optimal to raise debt as much as possible, that is, until you end up hitting a binding constraint. So there's 2 possibilities here. The buyer's constraint is binding in the bad state of the world. So that was constraint number 4 here. And then the second case is where the buyer's constraint is binding in the 5th constraint. So in the good state of the world. And this summarizes all the potential cases in the economy. So what I will do next is to put some numbers to this model and take it to the computer so I can show you how some of the properties of the model look like, and then get to the testable predictions. So I want to be very clear here. This is not a calibration. The model is being calibrated on Felipe's computer as we speak. I'm sure it's running. Okay, these are just sort of numbers that made sense to us. I don't want you to take them too literally, but I will tell you what some of the implications are from these numbers in terms of some statistics. So here are some of the statistics that come out of them. For example, about 23% of all the agents end up interacting with a wholesaler in this model. So that's 20% of them are just by assumption. So we have set alpha such that 20% of people cannot match, okay? There's gonna be very few instances where the buyer and the seller end up being in the case where there's no binding constraint. So that was case 1. About 15% of the cases will be case 2. So that's the case where trade credit is not state contingent, but constraints are binding. So then the majority of the cases will be in a world where constraints are binding and trade credit is state contingent. So that's roughly 61.5% of all the buyers, or 77% of the matches. So that is 77% out of conditionally and being matched. In this economy, also about 60% of the flows relative to GDP are due to trade credit. So the sum of accounts payable and accounts receivable out of GDP is roughly 60%. And about 60.25% of all the asset flows, where assets and liabilities flows here are just debt and trade credit, are trade credit. So let me show you what the equilibrium looks like. So what I'm showing you on the left-hand side is the value function for the seller as a function of the constraint of the financial constraint that the buyer is facing. So remember, the higher is psi b, the more constrained the buyer is. So when the buyer is not very constrained, so when he's close to zero, we see that there is a region where the seller ends up not being matched to the buyer. That, of course, can be exogenous because they didn't get the possibility to match, but more importantly, there's an endogenous component to that, that the seller cannot match with the buyer here because the buyer will always refuse that match. Their outside option is way too high because they're not very financially constrained, okay? Then comes a region where the agents are end up being matched, but they're both unconstrained, and the optimal production scale is being reached, as well as the case where optimal production is not being reached, but without state contingent trade credit. But then finally, the more constrained that the buyer is, the constraints are really binding here, and state trade credit ends up being state contingent. So you can see that the case 4, which is the case that in which the constraint is binding in the good state, ends up having the highest, the maximum, the highest value for the seller's value function. So on the right-hand side, what I'm showing you is a 3-dimensional picture. So here, everything on the left-hand side was for any given seller. But now I'm showing you all the different sellers on the right-hand side. So I have the buyers on the x-axis and the sellers on the y-axis. So now we have regions where different equilibria occur. And these equilibria are corresponding to the case numbers that I presented earlier. So 0 means unmatched, 1 means unconstrained, 2 means constrained, but without state contingent trade credit, and 3 and 4 are constrained with state contingent trade credit. So what are some of the endogenous variables in the model looking like in these different equilibria? So I'm going to start by focusing on debt and production. And for case of simplicity, I'm looking at the seller's debt here. So I'm always showing you what the seller's variable looks like with the case policies next to it, because you can see the natural mapping between the debt and the case and which case you're in on the right-hand side. So the first observation here is that as you are going up on the y-axis, so as the seller becomes more constrained, their debt should be decreasing. So why is that? They can't raise that much debt because it's more costly for them to do so. The second observation here is that if you compare cases 4 and 3, which are both state contingent, the debt levels in case 4 are below those of case 3. And that's simply because case 4, which is the case in which the buyer's constraint is binding in the good state of the world, is case where it is much more costly to relax the constraint of the buyer. So therefore, the seller is not going to raise as much debt as he would in case 3. Similarly, I could have shown you a picture here for sales or production, and they look identical to what you see for the seller's debt. So the production scale ends up adopting the same properties as debt here, which is not a surprise. And then finally, you see that the seller ends up raising more debt when trade credit is state contingent. So how do you see that? You see in regions 3 and 4, which are the regions where trade credit is state contingent, on the rainbow that Felipe really nicely produced, the colors are much less blue, right? So that means that the values are much higher. So why is that happening? Why does the seller raise more debt when trade credit is state contingent? Well, that's precisely because of insurance, either to provide insurance or because he ends up receiving insurance. Okay, so now let's talk about insurance. So on the left-hand side here, what I'm showing you is the ratio of the payment of trade credit in period 2 in the high state of the world relative to the low state of the world, -1 for normalization. So this is the dispersion in the trade credit payment, or the volatility, think of it as the trade credit payment. So the higher is this dispersion, the more insurance there is in the model. So what are some of the properties of insurance that come out of this model? So first of all, notice that trade credit becomes state contingent when either the buyer or the seller become constrained. So that is to say, you move to regions 3 and 4 when somebody's constraint starts to bind. Trade credit is highest in case 4. So that is the case in which the buyer is constrained in the good state. That was the case in which debt levels and production were lowest from the previous slide. And that's, once again, simply because the cost to lower the debt differentials is smaller than the cost that you incur due to production differentials, due to the curvature of the production function. So in this case, you have to increase the state contingency of trade credit the most possible in order to reach the highest scale of production. And the final observation here is that the more constrained an agent is, so the higher is their psi, the more debt constrained they are, the lower their profitability is. And that's simply because their outside option in this case is the lowest. And those are exactly the cases in which the most insurance is needed. So there is a deep connection between the profitability of the agent, which captures effectively their financial constraint, and the need for insurance. And these are precisely things that we will be testing in the data. The last prediction that I have for you here refers to the firm's volatility. So what I'm showing you here on the left-hand side is a plot at the firm level of the volatility of trade credit, so the dispersion of trade credit, those T's, and the volatility of their sales. Obviously, this is only applicable to cases 3 and 4, where trade credit is state contingent. And what you can see is monotonicity. More volatile are the firm's sales, the more insurance is needed. More interestingly, also, more insurance is needed in case 4 relative to case 3, precisely for the same reason as I explained on the previous graph. So these are the predictions that we will now test empirically using the Orbis database.
Ina?
Yeah.
Just a quick question. So, so all the matching is done because of the heterogeneity in the size. If you kind of think of like efficiency, should there be like negative assorted matching? Is that what we want, like high psi with low psi guys going together? So that's kind of like given the quadratic structure. Just kind of
I think that from an optimal policy point of view.
Yeah, I mean, you want one guy on either with the quadratic stuff. It seems like you want one guy to have like an easy way of borrowing and then just provide to the other guy.
I suppose so. In this model, yes, because we don't have any other reason for which people like to be matched, right? But if of course you introduce another reason, so for example, there's an extra surplus, right, in efficiency that would arise by being matched to a high productivity guy, then that is no longer the case. But we didn't want to pollute the trade credit kind of provision with extra kind of reasons for which to be matched. You will still want to provide trade credit. In fact, in that case, you'll probably want to provide more trade credit because it's like you really want to stay matched, right?
Okay.
Yeah. So what's, sorry, another question? No? Okay. So the first simple specification will try to get at the prediction that financially constrained firms obtain more trade credit. So in particular, we're going to run the following specification. So we'll compute net trade credit, which is accounts payable minus accounts receivable for each firm, firm I, in country C, in sector at time period T. And we will regress that on a firm fixed effect on a country sector time fixed effect. And then on the sales of the firm in that period, on their EBITDA, which is trying to capture our financial constraints, and a bunch of other firm level controls, which I will show you in a minute when I show you the regression results. So the underlying assumption here is that firms in the same country sector time will have similar trade partners conditional on other firm observables, such as sales, EBITDA, and all the other observables that I will show you. Okay, so the prediction here from the model is that large and financially constrained firms obtain more trade credit. So we want to see a positive beta and a negative gamma. So I'm showing you here two regressions. The first column is a regression where debt is proxied using short-term debt, and the second where debt is proxied using all debt liabilities. And the controls that we're including for the firm here are, in addition to sales and EBITDA, which are the things that we're interested in, it's the firm's debt and the firm's capital, log employment, and log assets. I should say that net trade credit, sales, EBITDA, and debt are all relative to the total amount of assets, because we want to take out scale effects and we want to be aware of the fact that debt and trade credit are not the only sources of financing in the data. And what we're using here is data for 8 emerging markets. They're listed in the table below, and the data goes from 2009 to 2019. So as the theory predicts, we're finding that the coefficient on sales is positive and the coefficient on EBITDA is negative. Now we want to test the insurance channel. So here, the model has predictions about what the dispersion on those T's, which is the volatility of trade credit, should look like as a function of certain variables. So here, I'm no longer running a regression each period because I have to compute the volatility for each firm. So we will compute the volatility over time, and we will be only keeping firms for which we have at least 6 annual observations. So we have the volatility of a firm I in sector S, country C, and that's regressed on a firm fixed effect, on a country sector fixed effect. And now I have the mean sales of the firm over the period, their mean EBITDA, and their volatility, as well as the other firm level controls as before. So the prediction of the model here is that the larger are the firms, the more financially constrained they are, and the more volatile they are, the more state contingent trade credit they obtain. So that is to say, the higher is the volatility of net trade credit. So here are the results from that regression. Once again, 2 columns, one for short-term debt, one for long-term or for total debt. And we're finding that sales are positive, EBITDA is negative, and the volatility of sales is positive as predicted by the model. So finally, what I want to do is to convince you that in this economy where we have state contingent trade credit acts as a macroeconomic stabilizer. George, now I see you twice and you're confusing me. Why are you in a different picture? Okay, your face is in a different picture. So now I have 2 economies. First, I have my trade credit economy, where the matching rate is 80%, and I have an economy without trade credit. So what is an economy without trade credit? It's an economy where you only interact with the wholesaler because you don't have access to trade credit, you don't have bilateral meetings. And we will consider 2 different counterfactual episodes. One where we will have a financial shock. So in particular, we will have a 10% increase in the cost psi j for each agent j. And then we will have a demand shock, where a negative demand shock, where we will decrease by 10% both the high and the low price of the final good. So the question is trade credit a stabilizer in the model? So I'll show you some statistics of the baseline, so the model with trade credit versus the counterfactual without trade credit. So in the first block here, we have the financial shock. The second block is the demand shock. So what you can see is that the economy with trade credit has a lower contraction of GDP due to both the financial shock and the demand shock than the economy without trade credit. Similarly, the price decreases by less in both the in the economy with trade credit due to either shock. So this is showing you precisely that the shock is being mitigated. How is that shock being mitigated? The next two columns show you that. So first, I'm showing you what is the change in accounts receivable plus accounts payable as a fraction of GDP in the model with trade credit due to either shock. You see that when the shock hits, the model with trade credit sees a decrease in trade credit relative to GDP. So due to the negative shock, trade credit as a fraction of GDP goes down. There is overall less borrowing and lending in terms of trade credit going on in the economy. But relative to the total amount of flows of assets and liabilities, which is now trade credit and debt, that fraction is higher. So that is to say that that trade credit expands relative to bank credit during crises. And that's why crises are milder when trade credit is available. So overall, we conclude that trade credit not only provides firm level insurance and production efficiency, but it also mitigates effects of aggregate shocks to the economy. To give you a sense of what happens in the data, I have the following regression where now I'm using a different data set from the Orbis data set. I'm using now a data set for Mexico, for Mexican firms for which we have different types of funding sources. So a breakdown on all of their funding sources, as well as different types of assets. So what I'm going to look at here is what happens when there is an increase in the funding source for a firm and how that translates into the accounts receivable, that is to say the amount of trade credit that they extend to other firms. We want to see what that looks like under normal circumstances and what it looks like when there is a crisis. So the coefficient beta 2, if positive, will be capturing the extra effect that comes out during a crisis period. And here are the results. We're using here quarterly data from 2005 until 2015, and the crisis period will just be a dummy variable that we put during 2008 Q3 until 2010 Q2. So this is the global financial crisis. So what you see is the following, is that whenever the cash flows of the firm go up, or their corporate bonds, or their loans, or their trade credit, or any other liability, those firms channel those increases in funds toward more accounts receivable. But more interesting, in the cases of cash flows and bonds, you also see that during crisis, they extend even more trade credit than under normal times. So this is precisely what we have in mind here, with firms extending their trade credit during bad times in order to provide their counterparties with more insurance. So to summarize, what I've done here is to show you theoretically and empirically that firms trade off debt and trade credit, and that less constrained firms provide insurance to more constrained partners via trade credit. I also showed numerically that financial and demand shocks are mitigated in an economy with trade credit, and therefore trade credit is a macroeconomic stabilizer. So now, of course, your question is, well, this is the international trade and macro seminar, and I saw nothing international in it. Why is that? Because this is still a work in progress paper. So here's where we're going with it right now. Now, there, my co-authors have a previous paper where they used data for Mexico for listed firms, for large firms. And what they documented in that paper is the following. They find that large firms in Mexico exploit cheap dollar funding in order to provide trade credit denominated in pesos to their related parties. They also find that these same large firms that borrow in dollars decrease investment more and maintain trade credit lending more than other firms when the peso depreciates. So what this is telling us is that these firms are trying to insure their partners even in cases when their financing becomes more expensive, since the peso depreciates and they're borrowing in dollars. So when we extend our model to include both domestic and foreign currency debt, then our model reconciles facts on home and foreign currency borrowing that we know from the literature, but it can also, most importantly, reconcile this insurance fact that Felipe and Brian are documented. So in particular, in our models, large firms end up protecting value chains by absorbing the foreign exchange shock, and trade credit provides insurance along the supply chain as a consequence of that. So we're currently quantifying the effect of a devaluation in our general model, and we're also going to some firm level data that features devaluations in order to be able to test more empirically some of the predictions of that model with domestic and foreign currency debt. But the conclusion that we want to reach out of that is that basically dollar debt can end up being more beneficial in emerging markets than we previously thought, because by being channeled via trade credit, via the big firms and trade credit to small firms, it provides extra source of financing, especially during bad times. So that concludes our work today. So thanks for all your comments, and I'm happy to chat more.
Okay, great. So now we'll just open it up to general questions and comments, and I'll go first because
are we still recording, or are we stopping the recording? Okay, I'm just.
That's up to you. We can stop recording if you want.
That's fine. I want to know like how I.
You can't say anything too nasty about anybody right now.
It's more just to watch my mouth and in other ways. Okay, go on.
So let me start. I'm still not sure I got my brain wrapped around all the pieces. What is it in the parameterization of the model that makes these things be shock absorbers and not like shock amplifiers? Is it a parameter value? Does your model nest cases where these things are not good for shock absorption, or is that kind of baked into the model and then it's just a question of how big is the shock absorber?
So I mean, definitely there are opposing effects here. I mean, it's not baked in, because as I showed you earlier, right? Like like trade credit relative to GDP even like goes down in this particular parameterization in the model. So there's always a trade-off here. But it's the way that I want you to think about it is that if there was no insurance, so if trade credit was not state contingent, then shocks would propagate through the economy.
But what would you have to do to your model to make that be the case?
I think that would be case 2, right, Felipe?
Okay, so what would make you always be in case 2? I'm just trying to get at like, what is it making the model end up having this absorption quality? Like,
an easy way of getting more case 2 is to increase the cost of doing the contingent trade credit. So that cost that we have there, that's going to determine how easy it is to provide this type of insurance.
That's that XI or whatever that thing is called.
Right. Yeah. That's right. So if this XI is very, very high, that'll push you, away from state contingent trade credit.
So if it's expensive to issue trade credit like this, okay, that's the parameter. Okay.
That's one of the parameters. And the part that you were saying, maybe it's baked into the model, is the fact that whenever you are interacting with a wholesaler and you get these kind of shocks, the shock hits one-to-one on the buyer and on the seller. You have to absorb it all, basically. But whenever you get the financial shock as a couple, what we can do is exactly what George was saying at the beginning. Basically, the relative side tells you that we should each absorb the shock according to our capacity. So instead of you, Kim, absorbing 100% of the shock and I absorbing 100%, I can absorb 150 so that you only absorb 50. And that has efficiency gains given the curvature of the risk function.
Okay, gotcha.
So I'm having some like technical difficulties. That's why you saw two of me, Ina.
It's okay.
Sorry, sorry you had to look at me so close. Anyhow, so I guess I didn't see this. Like, have you guys gone and tried to see if these shares of trade credit that you kind of started out by showing us at the beginning actually do affect kind of the volatility of countries? You could imagine, like, if you looked at like, it's always difficult because each country is getting hit with different shocks, but you know, there's some global shocks, and the countries that had like more trade credit, do we see that for the same level of development or whatever, they end up having like, you know, smaller aggregate fluctuations?
So we haven't done that. It's an interesting suggestion. This data is available. It's from the World Bank Enterprise. So one could potentially run a regression. But of course, as you said there, there's just so many other things that affect the volatility of GDP that then once you start running volatility of GDP regressions, there's just like a kitchen sink of stuff you have to include on the right-hand side. But we could do a simple plot and see it, right? If there's something there. Yeah, well, I don't see why not.
I mean, you know, that's one of your kind of final takeaways, right? So it'd be nice to kind of come back to the data and somehow show us that there's some of that. So, and you know, I think everyone would sort of say it's a challenging exercise, right? But there's probably some smart identification you can do, and if you can't, you can just sort of throw up your hands and say it's a challenging exercise.
So let me ask you something, George, on that respect, to see if you would be happy with something like that. So on the Orbis data, we have account receivables and account payable at the firm level. So what we could do is going industry by industry and calculating there the prevalence of trade credit and the volatility of sales. And then I can do this in a regression where I have country time fixed effects or country fixed effects, so that we'll be comparing different industries within a country. I think that that's the best that we could do with the data we have.
Yeah, I mean, you could definitely do that. You could also do it with just like industry fixed effects in the panel. And then that's another way of doing it.
Yeah. So you basically kind of want a version, almost like a reverse version of what I showed you for the volatility of trade credit on volatility of sales. You want to put volatility of sales or GDP on the left-hand side and on the right-hand side. Yeah, this came up also in Wisconsin in some way. So I think it's a good suggestion. Yeah,
I just want you to kind of loop back to the, you know, your punchline. So
Yeah. No, I like it. That's great. Yeah.
Cool. You guys can hear the bells ringing.
Okay, and I saw that Felipe was dealing with the chat, so that's hopefully been taken care of. Okay, great. Well, thanks. This was good, although you should now have us over in Rochester in person. More fun.
You're the first person who said they wanted to come to Rochester.
I've been there once. I went there to Carnegie Rochester many years ago. Actually, it was pretty good. We had a good time.
Pretty good. Yeah.
Actually, yeah.
But it was during spring. It was like the perfect day and everything was blooming.
Just like every day in Rochester.
Right.
We'll make it happen.
Sounds good.
Sounds good.
Thank you.
All right. Thanks, everybody. Yeah. Have a good day. See you later.
Bye.
Thank you. Bye.
Let's see if I can figure out. Sorry about this. You know, my technology's all messed up. So
what? Oh, it's okay. No, this worked out great. Thanks, George.
You know, it's in my office right now. My screen. I don't know if you saw like the last Incredibles with like the screens that just like are flickering. my main screen is just like flickering and it's like a seizure thing. So
Yeah.
yeah. All right. Well, everyone can hang up and I'll try to figure this out. See
All
you
right.
guys.
Bye.
Bye. Fun as always.